my mind, it's a harbinger. It's a red flag that's telling you that there is something profoundly wrong in the money system of the world. These are the highest interest rates ever since Jesus. They're actually higher than the nominal rate because we've got like 4 times the debt load. So the multiplier and its impact. I mean, the housing market's dead. Yes. We're in the environment that something's going to break, and it's going to feel really, really scary, and there's going to be a big correction.
Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need for your portfolio. And today I'm joined by Sidney Freed as always, and today we are also welcoming Hugh Hendry. He is the ACID Capitalist, also a former global macro hedge fund manager. Thank you for stopping by here on a very warm afternoon in New York. Today we're going to be talking about smart money, and definitely a loaded term, perfect for discussion with a former hedge fund manager. Our phrase of the day is safe haven. Is it Bitcoin? Is it gold? US government IOUs? We are going to discuss. And this episode brought to you by the number 162. That is how many yen you need to buy $1 if you round up. Now, Mr. and Mrs. Watanabe fit into the global currency endgame. We will discuss that. Sidney and Hugh. All right, we're talking about smart money. You used to run money. You're sitting today across from me, dressed very casually. So I'm thinking that you might have departed the money universe here and done some other things. I'm wondering how do you see the global capital markets now?
Heavens. I mean, first off the bat, I think I'm the smartest, dumbest looking person you're ever going to meet. With this notion of dumb money or wise money or smart money, I mean, money's just dumb and is greedy. But on the dumbness, people sell you financial products. You don't buy them. And in terms of my appearance, I like to kind of shock and provoke. I want to be the antithesis, if you will, of the disgraced former financier, Bernie Madoff, who made off with the money. And he was impeccably dressed, and it's like, wow, yes. I want to give that guy my life savings. Whereas I want you to hesitate. I don't want your money, but I want...
The volatility is in your garb. I love it.
And I wear there's a famous Buddhist saying about licking the razor's edge. And with me, I want you to lick the razor's edge. I want you to think about it. Because
I'm thinking about it right
it's a fascinating subject, and there are things we can say.
Hugh, what was it like to run a hedge fund? Was it stressful? A little bit of fun? All work, no play?
I remember my mentors, let's see if I can remember, the 3 most important characteristics in life. You should be playful, you should be curious, and you should be mischievous. And I was all 3 of those things in my career. In terms of stress, I ran a global macro fund, and my fund, the basis or the objective of my fund was to be like no other fund, not to correlate.
Eclectic at capital management.
To be eclectic, if I made money, I made money out of sync with everyone else, and I lost money when everyone was making money, so it was quite lonely. And the brain, there are no portals into the brain. The brain trusts the voice. And I spent too many days saying, like Mortal Kombat, I'm like, they got me. I'm not going to make it. I'm going to die today. And your brain actually believes that. And it pours out all this toxic chemicals. So after 15 years, I kind of had to seek retreat in the glorious surroundings of St. Bart's in the Caribbean.
Do you think if you had approached it differently, and maybe that's just not your personality, if you tried to go with the herd and you were making money with other people and you weren't so at odds with the business cycle, do you think it might have worked out?
You tell me it didn't work out, baby.
Do you think you might have stuck with it? Because clearly there was a little bit of burnout. That's where I was going.
It was more did I excel? Am I using the superlative term to describe my performance in 2008? The worst financial returns in 100 years, the month of October 2008, and gloating, I made 50%. But after that, the authorities came down and just loaded the sector with a profound degree of regulatory bureaucracy, and it raised your break-even assets under management fund client money from like you could. When I started, you could run a hedge fund with $30 million. When I stopped, your break even was $300 million.
So the barriers to entry, usually, I mean, the theme of technology over the last 1,000 years is barriers to entry come down. You're saying they've gone up in the hedge fund space.
Yeah, there's no technology in there. I mean,
Okay.
Hey, listen, hedge funds investing again, right? I'm now on the other side, but it's just a silly business. You are pretending that you can see the future. And actually, sometimes I think I did, but I'm the ACID capitalist. If you want to see the future, you got to get high. You ain't going to see the future like looking for straight lines, linear lines off your spreadsheet or off the sharp lines from your suit. It's the mavericks like me that are out of step, and sometimes we see the future.
I llove how when I was watching a couple of old videos with you, and you talked about the value of misbehaving. You were expected to maybe become an accountant. I don't want to tell the story for you, but tell me about how you have been misbehaving, how you've used that to your advantage.
Oh God! All right, misbehave. Well, do you know what? Let's misbehave now.
Let's do it.
Because the audience, right? I'm guessing one of their favorite acids.
Oh, be careful there.
That's a Freudian slip.
Assets is gold, right? The yellow metal. Gold. I mean, let's say positive things. I mean, it's made from exploding stars. The energy that gives off creates
not to nuclear fusion,
heavy,
yes.
Yeah, these heavy metals. It's interstellar, right? And there's even the veneer hypothesis that the gold deposits we have on this planet came from meteoroids. I mean, it's pretty
That
damn
means there's
cool.
more meteorites out there with gold just waiting to come in turn.
Well, I mean,
maybe.
I hope they wait a little bit longer before striking.
Well,
but anyway, okay, so wow, it's incredible. Okay. And then secondly, I've got good form and good grace with the yellow metal because my first year as the hedge fund manager, again, I'm gloating, but like most people think I'm an idiot. So my first calendar year, I made 50%, and it all came from gold. 2003 was the end of the bear market. Were you going to say something?
And it was a long one.
I was going to say, I was trying to figure out what age I was in 2003. I was listening. I wasn't thinking about gold in 2003.
God, I hate that when you're in the bar and the girl says, "What age are you?" I'm like, "Yeah, I'm worried you might be maybe just too young." But anyway, so it got to $850 in 1980. 2003 was like I was buying.
That was a nasty bear market in between. So
that was like, okay, let's talk about bear markets. The Dow famously peaked in 1929. It took 25 years to regain the high in 1954.
along with stocks, I think too.
The stocks, yeah. Stocks took 25 years from the 29 peak. In Tokyo, 34 years, and the gold bear market was kind of just it toggles between the two about 28 years, which is to say, in 1980, it was in a bubble. And like the gold people, so now we're misbehaving because you're not allowed to say that gold could be a bubble, right? But it was a bubble. And we can actually do, let's actually try and pretend we're hedge fund managers. We'll talk about statistics because.
Are we misbehaving now?
Will you pay me like a hedge fund manager?
We're going to shock people because we're going to actually, let's do insight, okay? Because gold gets a real free ride in that, how do you value gold? Like with stocks, you got a price earnings ratio, you got a dividend yield.
Maybe measure the finite supply, do some backhand calculations with the amount of fiat on Earth and see how much gold fills the void. That's maybe how it's done.
You're talking nonsense, but anyway,
Oh, it's nonsense? Okay.
I was thinking you were my hedge fund analyst, and I was chewing you up.
I'm just regurgitating what I've heard before.
Okay, so indeed. So ChatGPT.
That's my middle name.
Keep on track here, Hugh.
So let's do it the way like a global macro hedge fund would do it. Okay, so something which is quite a robust, stable denominator, if you will, in terms of the valuation of gold would be global GDP, the total income of the planet, okay? And so in 1980, right, when gold was $850, what was the total value of gold expressed as a percentage of the economy? Now, you guys read the financial press, I'm sure, obsessed, right? Have you ever heard that metric? Do you know what the number is? Because the people out there are like, I don't know, but this sounds interesting, okay? So it was 20% of GDP, 20.5% of global GDP. And people are telling, because you're teeing us up for safe havens, as a gold, as a Bitcoin, and everyone's like, wow, US stocks are massively overvalued. But again, okay, so we can value stocks, but how do we value gold? So they're saying that the safe haven is this gold, but I'm going to come back to you and say, well, what's the corresponding valuation today for gold vis-a-vis global GDP?
How does it stack up?
And it stacks up, it's at 16.5%.
Interesting.
So gold was, we know that 20% of GDP, it took 28 years to recover from being excessively overvalued, right? And we're 5 percentage points of GDP, of 5 percentage points on that ratio away from it being in a profound bubble. What would that price level be? It would be $3,000. So I want to say what my experience as a hedge fund manager is that if profoundly bad things happen, if they lose, and what is profoundly bad things happen? LTCM, the largest head, 1998, okay? And why did that go down? It went down because the Federal Reserve, I think they're honest, I think
They mean well?
They mean well.
The Federal Reserve means well.
They mean well, but they're clueless, okay? And I want to, and again, I want to be...
models. They got models.
What did I tell you? The future ain't going to come at you in linear spreadsheets. We got to get higher.
Oh, that's tough for Jared. Jared loves
you're
some
just
spreadsheets and charts.
I like exponential spreadsheets.
All right.
I'm dyslexic with spreadsheets. So I'm just a little... So two things. That gold actually seems to be quite... It's rich. Everything is rich. We live in a world where everything is overvalued. You were trying to guess your age in 1980.
All right,
I mean, were you born? I don't know.
Just because
My
I'm not good at
spreadsheet
math, I
says
wasn't
about
trying
that.
to guess. I was trying to calculate.
Okay, but what I mean by that is in 1980, okay, it was the opposite. Everything, except gold, everything was cheap. And no one owned stocks. No one was interested.
Yeah, we saw the death of stocks headlines or a cover of Newsweek.
No one wanted to own it. Like personal sector, household sector, stocks, mutual funds, get out of here, right? And now, here we are, 40, 50 years, 45 years, later, and stocks are massively overvalued, and everyone is clamoring to own them. So we're kind of out of sync with the world. Everything is overvalued. Now, in the context of everything being monstrously overvalued, I've got a kind of soft spot, again, on kind of like ACID kind of logic for Bitcoin. Because Bitcoin, in the scheme of things, is tiny. Bitcoin, in terms of its total capitalization, so we're talking about gold, total capitalization of gold is between 16 and 17 trillion dollars. Total capitalization of US stocks is $40 trillion, and probably US treasuries is something similar, okay? Bitcoin is 1.3 trillion. It's just tiny, it's teeny weeny.
So if it had to fill the void, I get your argument. If it had to fill the void, you would expand that multiple.
Well, I'm saying to you, if gold tripled, the value of gold would be greater than the capitalization of US stocks. And that kind of feels like a bit of a reach. But I mean, if there are some smart people, and I'm sure there are smart people listening and watching this, they will be saying, yeah, but in 1980, the value of gold, all above ground reserves in gold, was actually 2 times the total value of US stocks. So it's not impossible. But I think if that scenario, if gold is 2 times the value of US stocks, I think US stocks will be 50% below where they're trading today. That's not my prophecy. I'm just saying that's how I think you could get back into that ratio. So when I look at the world, and again, if I'm a kid, all right, I don't have much money. I'm kind of keen to get in the game. Everything is overvalued. And I need to make money. I'm not in it to compound it 5, 6, 7%, okay? I need to make big bucks. What's the one asset that could triple, and it really wouldn't make any big difference? And it's Bitcoin. If Bitcoin tripled, it'd be the same size as the NVIDIA market capitalization, or just slightly greater. It's not impossible.
We got to pause right there. We're going to take a quick break. Coming back, we're going to be talking about the magic number of the day. It has to do with the Japanese yen. And we've got it, who wore it better for the ages? Stay tuned. All right, we are back, and I think we've been talking about safe havens the entire show. And I just got to define this real quickly, and then I think we'll move on. Safe haven is an investment that's expected to retain or increase in value during times of economic stress. And just to tie this back to our conversation, do you think Bitcoin can fill that role by itself, or does there need to be some gold in the mix, or anything else?
So were the 3 questions there? The first question, can it fill that? Can it fill that role? No.
Bitcoin cannot.
Cannot.
With the help of other assets, treasury bills,
and then you
gold.
said with the help of gold, and I've just said to you, I think gold is like almost as preposterously overvalued as stocks. So that won't really help me, okay? And safe havens, I think safe havens are oxymoronic. I don't think they really... Let me give you my definition of a safe haven. Safe haven is the most reviled asset class. It's an asset class that's had a profound drawdown, and everyone's like, oh, it's like a bad day. It's like, oh, I just don't want to think about it, yeah? And today, that is long-dated U.S. Treasury bonds. Yeah,
the 30-year.
The 30-year. So if we look at the proxy for that would be the TLT, the ETF, that's halved in price. And like everyone doesn't like it. Now, what will risk-free government bonds do if something really bad happens? They'll go back up in price. And then to close this kind of, again, these notions of being playful and mischievous and curious, the US Treasury bond market has been in a 50-year, it's the greatest bull market of all time. And it began, if you will, with a double bottom. I'm not talking about anatomy, I'm talking about like the price double bottomed, right, between 1982 and 1984. It was preposterous, actually, that bonds were as weak in 1984 as they had been 2 years before. But there was a psychosis that people were concerned about inflation, and the US economy was recovering. Like, wow, inflation again. And that double bottom set a floor for this stupendous bull market. And so I'm kind of the disposition, I think the US Treasury bond market, bull market, will conclude with a double top, if you will. And so we saw a profound top. And I don't think that top or that low in US Treasury yields that we saw during the pandemic period in 2020, 2021, which, like, let's call it 50 basis points, I don't think we'll see that. But I think we could see a profound rebound in bond prices. And then I'd be a seller, but step by step. So the safe haven, the most sound way of having something protective in your portfolio wouldn't be the treasuries. It would be options to buy the treasuries, because one of the things that kept me wealthy was I only bought things going up. And I sold things going down, okay? Now, again, to the really smart people watching and listening, bond prices have been going down for 3 years, okay? So I can't actually commit a lot of money to, like, if you will, physically owning these things, but I can buy an option with 2 years of life at today, like, with the strike price at today's level. And if it strikes, if it goes to like 140, I think we could see 140 over the next 2 years. Boom, I'm going to make money, lots of money.
So Hugh, if you're early to investing, how can you misbehave, or should you misbehave?
For new investors.
For new investors, when they're looking at how to build their portfolio, I heard you only invest about 10% of your net worth in stocks. Is that misbehaving to someone who's just starting out? What do you think?
Well, yeah, so I get horses for courses. So the 10% ratio, I'm saying, like, for most people, the majority of your wealth is you bought a house 10 years ago, 15 years ago, 20 years ago, and it's a lot, and the value of it is a lot higher than your mortgage. And the gap between that's your wealth, okay? And so if I was going to have a risk portfolio, I was going to buy equities and Bitcoin and gold and some treasury options. I'm saying that the total amount that I would lay out there would be no more than 10% of that wealth thing. And then today, because everything's overvalued, it would actually only be 5%. And it'd be 5 because I'd be holding the other 5 back, because eventually things correct, and then they get cheap. And the worst thing is when they get cheap, all these people, like, you remember the Bible with the apostles and Jesus, like Jesus, like, oh, tomorrow's gonna be a bad day. I'm gonna get hung. They're gonna crucify me. And like, oh no, you're getting a lot of. I know you're getting like a lot of pushback because I'm gonna get they're crucifying me, and they're gonna come at you and they're gonna say, do you know me? And you're gonna deny it. And like, that's impossible. And the cock crowed, and it was like, the guy with the beard, never seen him. So what happens is there's so much faith invested in investing, and it gets in the way. So in terms of the kids, like, don't believe in anything. I like it. And don't be afraid to be dumb. And like, keep it dumb. Buy things going up and like sell them when they go down.
Hugh, I'm never afraid to be dumb. Never.
All right, I want to talk about things that have gotten cheap here, and that would be the yen. This episode brought to you by the number 162, which is The dollar value. So you got 162 yen to the dollar right now. This is what, a 35, 40-year low for the yen. But the Bank of Japan has kind of painted themselves into an interesting situation. What do you think about what's going on?
Okay, so again, I've got to correct your language.
Okay.
So we're going to again pretend we're like smart global macro hedge funds, right? Things are not cheap; they're lowly rated. Right?
Very good.
They sell at a price which reflects heightened risk. And the risk concerning the Japanese yen in terms of being a store of value, because it's had an abysmal and a very remarkable failure over the last 18 months. Those Japanese citizens, 18 months ago, they only required 115 yen to buy $1. And now, of course, they require 162. So you've got to work more, if you will, to earn a dollar. And that is an exceptional event. And so I would say the yen is not cheap. The yen is trading at a level that says it is in such a precarious position fiscally and with their room to maneuver that it could trade 200, 250. So the only good news is
That's a lot higher, a lot lower, depending on how you look at it.
Well, indeed, the yen would devalue more. But the devaluation to date is of historical importance, and it, to my mind, it's a harbinger. It's a red flag that's telling you that there's something profoundly wrong in the money system of the world.
I'm really interested in this, but I'm wondering if the average U.S. citizen or investor, I should just say, should care about what's going on with the yen.
Yeah, because if we trade $200, $250 yen,
you know it.
US stocks ain't going to be trading here, So the thing that's going on is, at the end of the 1970s, the West German Chancellor, what was it called, Helmut Schmidt, he said, "Oh my goodness, interest rates are as high as they've ever been since the birth of my friend Jesus Christ." Yeah?
Going back to that,
because remember they were 16% or whatever back then. I want to say that the Fed at 5.25 to 5.5, these are the highest interest rates ever since Jesus. They're actually higher than the nominal rate
95th
because we've got 4 times the debt load, so the multiplier and its impact. I mean, the housing market's dead. You can't move house because you've got a 30-year at 2.5%, 3%, and if you were to move house, you'd have to go into the market. It's dead. These interest rates are really high, and Japan is under pressure to raise interest rates. Because they've been at zero or negative for 2-3 decades. Mm-hmm. The problem is they spent so much. We keep lashing the U.S. government. We all want to be fiscally conservative. The Japanese have just been hosing yen domestically.
Well, they import oil based on or priced in U.S. dollars too, and there's not an easy way around that.
But they also have they do have a huge. They make things really well, and they do run a corresponding trade surplus. The problem is the problem is the Chinese have copied them, but they built bridges to nowhere, etc. They ran budget deficits every year for 35 years at 6% of GDP, and so even though interest rates are zero, the servicing of the government debt in Japan takes 35% of all the government receipts. And that's what the US is today, but US rates are 5.25. So Japan actually would go bankrupt if they raise interest rates. So the financial market, smart people like me know that Japan really is in a bind. And we know that when you've got very, very high interest rates, something breaks. We mentioned LTCM from 30 years ago. Yes. We're in the environment that something's going to break and it's going to feel really, really scary, and there's going to be a big correction.
This happens about once every 10 years, sometimes more frequently. We got under a minute to go. What does that look like? Any final words for investors here on that?
It's meant to happen every 100 years, but we built a system around an unsustainable trade model, which we don't have time to discuss. And things that should happen once every 100 years are happening once every 10 years. And so I think you're quite right. The money system is dying and is going to come to light. The yen is just the first warning, so watch out.
Always interested to see what rises from those ashes, though. As always, thank you, Sid and Hugh. It's been a fantastic pleasure to have you drop by here. Keep it locked to Yahoo Finance.